So let me summarize where we are, and then let's proceed forward to the new material. All right? So quickly going through it, just to make sure we keep things here. It said, Chapter 1, short historical overview, right? Hopefully, in terms of testing internal knowledge there. Chapter 2, we looked at gifts, right? In the class, and we looked at the fact that Chapter 2 looks at accretions to wealth under Chapter 61 says everything's includable in income, but we learned even in Chapter 2 imputed income is not considered an accretion to wealth. And then we saw in Chapter 3 gifts of bequest. We saw the general rule under 102A. We saw an exception under 102C. We saw an exception to the exception under the Treasury regulations, and who says that's not unusual under the code. Then in Chapter 4, we looked at some other exceptions. Section 132, we looked at fringe benefits, right? We saw what is the meaning of a fringe benefit, to whom does it extend, sort of non-discrimination rules, all those sort of things. Start with Section 119, and for the convenience of an employer, and when those rules might apply. And then I just pointed out to you, for example, Code Section 74 affirms, right? Code Section 74 affirms that gifts, prizes, for example, are going to be subject to tax, right? No one's surprised, right? That if you win a prize, for example, on the game show, it's going to be subject to tax. So it's just an affirmation of what I suspect most of you already knew. All right, so that's Code Section 74. We skipped Chapter 5, kind of, just give you a case of what you're missing. Then we began Chapter 6. And Chapter 6 looks at sales or exchanges of assets. So what are the tax implications? And we know that when it comes to Chapter 6, that this concept of realized and recognized, and with respect to losses, Tina, what else do we need? That's our hand. Allowable, right? And Katia, what code section opens up allowable? Lewis?
165?
165, right? 165. And in terms of, does Congress make it easier or harder, Larry, for gains to be recognized or losses to be allowed? Congress makes it easy for gains, harder for gains. What do you think, Larry?
I think it's hard.
For gains? Ashley, what's your opinion?
Easy for gains and harder for losses.
Right, Larry?
Yes.
Yes, right? So keep that in mind. Congress is going to make it somewhat harder for losses. They have to meet this third criteria, right, for it to be allowable. We saw that there are loss disallowance provisions and the like. All right. So then the first half of Chapter 6, we looked at basis rules, right? You got to know basis, and Zach, when you make an acquisition, what's your basis in the asset?
The price that you bought that.
What's your authority for that?
1016.
Louise?
1016.
And what?
1016.
And 15
116.
and 16. Jeff, did you agree?
Basis adjustment.
But when you buy something, that's your initial basis, not adjusted, right, Louise? Right, Jeff?
Oh, 10, 12.
10, 12, right? 10, 12. Right? So, over 10, 12 cost basis. Now, Louise, if you want to make adjustments, where do you find those adjustments?
10, 16.
10, 16, right? 10, 16 for adjustments that can be upward or downward. And then we would have our adjusted basis under section 10, 11. All right? And then if I make a gift, all right? I make a gift, Nick, what's your basis in that?
The donor basis?
One sec, Nick?
Your basis is a carryover from the person who you got it from.
Okay, so it's a carryover basis. And Wes, is that always true?
No.
Not always true. When is it not true? Anna, what are you going to say?
The fair market value is lower than the carryover.
You give me an example. I'm the client. Give me an example when I'm going to use fair market value.
Well, if you give me a property that had a initial cost basis 10 and now the fair market value is 5.
Okay, so everyone hear the facts. I made a gift to Anna. It originally cost me 10. Now it's worth 5. Keep going, Anna. What happens?
Then my basis will be the fair market value.
Your base is going to be 5?
Yes.
Luca, would you agree that's always right?
No, depending on what price, what you sell it for.
Hey, keep going. What do you sell it for?
So now if I sell it for, so it was 10 and 5, so if I sell it for 7, I will have no gain or no loss.
If that doesn't, okay, keep going on it.
If I
One.
sell it for,
So Ivana sells it for 7. She has no gain, no loss. Authority for that is Treasury Regulation 1015-182. The example. Keep going on it.
yes, now if I sell it for, the cost was 5, yes, and, no, I'm sorry, the cost was 10, the market value 5. So if I sell it for 10, yes.
You sell it for 10, yes?
Yes, let's say. No, if my cost was initially.
You gotta know your own facts. I bought it for 10, and now I gift it to you when it was worth 5.
So if I sell it for 15,
You sell it for 15, any gain or loss?
then I would have, if I sell it for 15, my cost basis would be actually 10, so I have $5.
Everyone agrees you have a $5 gain. And then, when would the loss be disallowed?
And the loss would be disallowed if I sold it for 2, let's say.
You sold it for 2, right? The loss would be, the $3 loss would be disallowed, right? Well, excuse me, it would be allowed, I apologize.
It would be allowed.
We used the lower basis, that's what I meant to say.
Yes,
Okay.
the basis price.
Yeah, everyone agree? So we have 3 different fact patterns, but if lost property with an embedded loss is gifted to you, and it's subsequently sold at a loss, use the fair market value rather than my adjusted basis, right?
Yes.
Okay? That's section 1015. Yolanda, I die. I bequeath that stock that I bought for 10, it's worth 5. What's your basis and why? Okay, why? Neither, would you agree? I bought it at 10, it's worth 5, I died, I bequeathed it to Yolanda. What's your basis? Matt?
10.
10, why?
We take whatever was initially.
Say it loudly.
We take whatever the cost was initially at that point.
Is that true, Yolanda? Stephanie, do you agree? I'm sorry?
Not sure.
That's right, Edward? Never say it right. Go ahead, help me out.
Nikisha.
Nikisha. I have to do the phonetics on her. Nikisha. What do you say it is?
I have to hear the question again.
I bought it for 10.
Uh-huh.
I gifted it when it's worth 5.
Uh-huh.
Excuse me, I died when it's worth 5. Let me
Okay.
apologize. What's your basis in that?
It would be 5.
And Claudia, would you agree?
Yes.
Raphael?
I'm not sure.
Brandon?
I agree.
Why? What's your authority?
1014.
1014, right? A lot of the basis is fair market value, right? So in that case, the fair market value had declined to 5. If it had gone up, that would be the basis, right? 1014 is the basis equal to fair market value rule, right? You, would that always apply? Is there any exceptions to 1014? Not sure? Let me just ask Johnny. Any exceptions? Just say it loudly because we're
There's
big.
always an exception.
There's always an exception. Do you know what it is?
No.
Okay, got to know the exception, right, Karen? And what does it say, Karen? Can you explain to the class or to your clients here what that exception says?
If you have an appreciated property and you gift it to this person that's probably going to die very soon, and then they bequeath it back to you at this really, obviously, the high price then, so you can either want to pay the tax on it, that kind of
So just go through a quick back pattern, Karen. Make up a basis, make up fair market value, and tell me in the class how it will apply.
So, okay, I guess if you have this stock that you bought for $10 and now it's selling for $90 and you gift it.
Okay, so I'm dying. I bought something for 10, it's worth 90. Okay? Excuse me, I didn't buy it, Karen bought it. And Karen looks at me and says, oh, Solik, you're not looking too good today. Here's a gesture to make you feel better. And she gives me this appreciated stock. And she said, you know, if something should happen to you, God forbid, maybe you can give it back to me in your will. And I do. Okay, and I die within a year of receiving that gift. Her basis in that property would not be fair market value, would not be the 90. She would be saddled with the same $10 basis, right, that she had. That's 1014E, right, you? That's the exception. Right? Go ahead.
So it's a year in like 1 day.
You're good. You're good or you're dead. Okay? Okay? The rules, you know, it's hard and fast. Okay? And if you die 1 day before, you know, it didn't work. All right? I believe that brings us up to date in terms of Chapter 6. And we were about to begin looking at amount realized, but you guys tell me, was there anything else that we covered that I think that we had just gotten through on page 137, correct? Any questions on the material to date? Everyone good? Quick pause. Anyone do anything exciting this weekend? Any movie reviews? Anything to report? Nothing? Wow. Oh, go ahead. You did what? You bought a guinea pig. Okay. We need a name to that guinea pig. Fred. Okay, we have no Freds in this classroom, so you don't have to worry that it took it out on you. All right, well, enjoy the new friend you have. All right. Friend and Fred. All right. I myself have not much to report. I was running around, but nothing that can be replicated by anyone here. All right, so we're ready to go on with Chapter 6, guys? All right. So we're going to look at the amount realized, because remember, when we're computing gains and losses, Code Section 1001 is pretty straightforward. It's, I should erase this, it's amount realized less adjusted basis gives rise to gain and loss, right? We went through adjusted basis, we have to look at the amount realized, right? That's key. Okay, and we said all realized gains are recognized under code section 1001C. Under 1001C, but we saw that even there, not all realized gains are recognized. There are, right? There are exceptions. And we understand that code section 1041, for example. So I don't want to leave with the misimpression. Just like some losses are disallowed, some gains go unrecognized, right? So what the authors want to do is present us with the amount realized, defining code section 1001B. 1001B. And the authors present us with a case. This one is not that well known, truth be told. International Trading Corp. The commissioner. Beginning on page 138. And here, the company pays its employee, it pays some of its employees with stock worth $24,858 with a basis of $16,153. So the question before the court is if this company uses an appreciated asset to pay a bonus, does the company have a recognition event? Does that itself constitute a recognition event? Right? Meaning, if you pay with appreciated property, will that give rise to a recognition event? And the court, not surprisingly, says yes. Why? Because remember, the company in paying this obligation, $24,858, it's going to take a deduction. You're going to see this in a few weeks under code section 162, A, or a business expense, right? When someone pays you salary, they take an expense. Everyone agree? And whether they pay you in cash or property, they're going to take a deduction for whatever they pay you. So if they take a deduction for the full amount and they don't recognize the difference, there's going to be leakage to the code because they're paying you, if it weren't a tax, they would be paying you with pre-tax money, right? So that can't be. So the court here, this is the Second Circuit opinion, deems that to be a recognition event, okay? So not surprising. The outcome here is not surprising. If you, in your notes, you want to compare this, this is very similar to a case known as Keenan, K-E-N-A-N. And that's a very famous case. The Keenan case is very well known, right? So International Trading Corp, not a very well-known case, but the proposition it stands for is quite straightforward. What is it again? Simply that if you use appreciated property to satisfy a debt, it's going to give rise to a recognition. The famous case, the one that you can certainly name drop, okay, and people in the know will know this case, is Crane v. Commission. Commission. Very well known. Hopefully you guys had a chance to read it. Okay. You have a chance to read it? Not yet? Okay. And in this case, is it Jackie at the top?
Yes, I did.
Did you get there? Jay Ying? Let me get down to Alicia. You want to talk? There's a lot of people behind you, so just speak loudly.
So maybe I'll start. How about that?
You start and I'll fill in the gaps.
I read it 2 weeks ago, so.
All right, you're a little rusty. If anyone read it more recently, feel free to jump in. So keep going.
In 1932, the company took a mortgage. Well, no, I'll turn off the clock. Sorry.
You're gonna skip?
Yes, please.
Anyone else want to volunteer? Any volunteers on this? Go, Anna, go ahead, and Matt, you feel free to jump in. The two of you can tag team it.
So the case is about Mrs.
Just say it loudly, Anna, loud
The
voice.
case is about Mrs. Crane who inherited a building.
All right, picture for you all. Sadly, Mrs. Crane is a widow. Agreed? She inherits the property. And what code section do you immediately think of, Anna? 1014, right? Everyone's reading. You hear about someone sadly dying, and you think code section 1014, right? Right. And that means, right, no matter basis is equal to fair market value. Agreed? All right. So she dies, she inherits the property, and what does she do?
So property was encumbered by a mortgage.
Property was encumbered by mortgage, agreed?
And an interest on the property, on the mortgage. And my recollection is that the mortgage was the same as the value of the building.
Okay, so the property, when she inherits it, is worth, say, X dollars. Let's just make up a number, like $250,000, and the fair market value happens to be equal to the same. So there's not much equity she has in the property when her husband dies, right?
Mm-hmm.
And she continues to own the property, right?
Continues to own the property until she just gives up and can't get up with the payments anymore, and she sells it for a little.
Let me interject, and maybe Matt, you want to point out one important fact that during the time she rents out the property, right? And what does she do also?
And she deducts the depreciation.
All right, that's important. Under code section 167/168, Mrs. Crane does take depreciation deductions, right? And Louise, we know what applies when she takes depreciation deductions, right? What code section, Louise? Oh, you said it before, James. What code section applies? Louis?
116? No.
If you had a zero in between, you'll get there. I think you meant 1016, right?
Yes. Yeah,
I
yeah.
knew
I was looking at the right number.
1016, right? Right, Louise?
Yes.
So there's going to be a basis adjustment, agreed? As a result of her taking depreciation deductions, her adjusted basis in that property is going to go down.
So she decided at some point to sell the building.
All right, so she's now going to sell the building, right? And how much cash does she receive?
She gets a little bit more than what the mortgage value was on the building.
You have the numbers? $3,000, right? Okay, 3,000, but she incurs some expenses. 500, right? So she nets how much? 2,500. And under the then laws, you only had to report 1/2 of the capital gain. So it's not like she was committing tax fraud when she reports 1/2 of the gains for $1,250. She said, look, I got $3,000, I had $500 worth of expenses. She makes the argument this is a capital asset. We'll get into that later, but let's just not get into character issues right now. And she recognizes, she claims she should recognize $2,500. And under the then laws, like I said, report $1,250. Okay? That's her argument. She should only have to recognize his income, the equity. And at the tax court level, she's successful. The tax court level, she's successful, and the appeals court reverses the tax court, and the Supreme Court is called up to play because the IRS has a very fundamental difference of opinion. Matt, what does the IRS say is going on?
Equity is not the same as property.
Okay, so the IRS is saying, look, when you look at Code Section 1001, Code Section 1001 uses the term property, right? On the sale or disposition of property, you take the amount realized on the property less its adjusted basis. And the IRS says conceptually, the word property and the word equity are not one and the same. Because remember, the taxpayer wins if the taxpayer is to win on the notion that she sold the equity and that's the only thing she has to account for. Agreed? So what does the Supreme Court do? It has to look at the analysis here. Now, the first thing the Supreme Court does, and it's going to bootstrap its own position, is to look at what is the amount of her basis in this property, right? What is her basis in this property? Because only by knowing its basis, then the court will do, the second part of the court's analysis is what is the amount realized. So this opinion looks at, first, what is her basis, and then secondarily, what is the amount realized. And just again, you guys are getting, I hope, fingers crossed, good at this. There's cross-references to code sections that don't correlate to our code. Why? Because remember the year this case is being decided relates to the 1939 code. So if your head is spinning, like, hey, why does this match with our code? Did the Supreme Court get it wrong? No. The Supreme Court's using the then code. Right, guys? All right. So, Matt, Anna, the court goes through a multi-pronged analysis to, look, I'll let the secrets out. Ultimately, the IRS prevails. So the IRS, or the Supreme Court, in making its argument, is going to offer several different vantage points for why it's right, meaning why the agency is right, and by extension, why the Supreme Court is right. So, what are those arguments? There's several. Matt, Anna, do you recall one or two or three or four of them?
The arguments for the IRS, yes. Or
Yes.
Supreme Court. I mean, one I think was related to the fact that she was deducting the depreciation. So
Well, the Supreme Court is troubled that she's deducting the depreciation, but look, she was allowed to deduct the depreciation. But the court is saying, gee, you keep telling us to focus on equity, but in the meantime, you've got $25,000 worth of depreciation deductions, and if we should only be focusing on the equity, you don't have much, so how do you justify all those depreciation deductions? But remember, I'm the first to tell you that there could be asymmetrical outcomes in the code, so I can't seal the deal for the Supreme Court. And the first thing the Supreme Court says, let's pull out a dictionary, which is not uncommon, right? The Supreme Court often will pull out a dictionary, and this is no exception. Pulls out a dictionary, and in evaluating Code Section 1001 says, well, Congress used the word property, right? Everyone agree? Congress uses the word property. And when it uses the word property, it doesn't use the word equity. And the two, when they look up in the dictionary, this is spelled out on page 143, property and equity are not synonyms, right? So there's something flawed in the taxpayer's argument or the IRS's argument about relying on this notion of equity, right? Because that's not the right place to go. If Congress had intended to use equity, it would have instructed, Code Section 1001 would have turned on the word equity. It did not use the word property, right? So the first thing is dictionary. Second, even back in this year, meaning this year, the year of the Supreme Court, this is a 1947 decision. This way predates Mayo Foundation, at the Supreme Court case in the first chapter of our book. If you recall, that case said that Treasury regulations should get deference, right? If you recall, and they should be upheld as long as they're not arbitrary and capricious. Well, 60 years earlier, the Supreme Court essentially says the same thing, is that, hey, there's an administrative ruling on this, where the IRS says to look at the word property, not equity. So this is spelled out at the bottom of page 143. It says that the Treasury regulations that were then in existence say that we should look at the property itself, what it was sold for, what is its basis, and not the equity in the property. On page 144, the third argument is that Congress, again, knows how to use the word equity, knows how to use the word property. And the fourth argument, spelled out in the second full paragraph on page 144, is that if you were to use equity here, right? If we were to use equity, how easy or hard would it be to make depreciation computations based on the taxpayer's equity in the property? And the Supreme Court makes the observation from a tax policy perspective, it would be extraordinarily difficult, right? Can you imagine if you had to depreciate or tell your client how to depreciate property based on equity, which, let's face it, is fluid, right? Everyone agree that the equity in property is fluid? Depends on how much of the mortgage that year is paid off, depends on the fair market value of the property. Would you want the Herculean task of trying to compute depreciation on the basis of equity, guys? And I think we could all answer that question that basis depreciation is challenging enough as is. We would not want to try to do it on the basis of this hit or miss target known as equity, right? Equity varies from year to year, from month to month, from day to day, from minute to minute, right? So it would be an administrative nightmare to try to use equity on the basis of depreciation. For all those reasons, the court says that when the taxpayer acquired this property, the basis in this property, appropriately so, was its fair market value under Code Section 1014, right? Or the then version of Code Section 1014. And notwithstanding the amount of liability, like Anna said, the liability almost equal to the fair market value, or was equal to the fair market value of the property, that's immaterial. The basis in the property was its fair market value, and you did not net it, right, for any liability. There is no netting of the liability. All right. So once we decide that the adjusted basis of the property is the fair market value of the property on the date of death, what is the amount realized? What is the amount realized? Is it simply the amount of cash the taxpayer receives? Alicia, you were going to say.
It's not. It also includes the unpaid interest because it was forgiven and it was approximately $15,000.
I think they ignore the unpaid interest because it's deductible anyway under Code Section 163.
And the mortgage.
It's the amount of the mortgage, okay? So the key takeaway of the Crane case is the amount realized. Okay, the amount realized includes not only the cash you receive, but also any debt that the purchaser takes the property subject to, okay? So that's key, often missed by your clients and other practitioners, but not missed by anyone, hopefully, fingers crossed, by anyone in this classroom, okay? So I just call to your attention, if you were to open up your regulations, and hopefully everyone's experts now at looking at regulations, look at regulation 1001-2, discharge and liability. Everyone can find that? Discharge and liability. Except as otherwise provided in paragraphs 8, 2, and 3 of this section, the amount realized from the sale or other disposition of property includes the amount of liabilities from which the transferor is discharged as a result of a sale or disposition. Everyone see that? Stephanie, you got that? You got it? Almost there? John? loudly.
For the cross references.
What?
For the cross references,
Right.
is there any like mapping tool, or should we just kind of realize that basically that we shouldn't pay attention to the section in older cases before the 1954 code?
I mean, you curious, you can Google it. I'm sure if you put it in, it'll tell you the cross-reference.
I guess just for like exam purposes, I was wondering if that's something.
I think, by the way, actually, you would know it automatically. I mean, most of this is pretty, if they're referring to code section 1001 or 1014.
Okay.
And needless to say, I will not ask that on an exam. You know, what was the prior code section?
Okay.
So you could have other things keep you up at night, not that.
Cool. Thank you.
Stephanie, you find it? Ryan, you got it. All right. So, everyone see that discharge of liabilities is included as part of the amount realized. Just to make it clear, you guys, there's, if you look at C, 1001-2C has examples. 4 very easy to follow examples. In 1976, A purchases an asset of $10,000, pays the seller $1,000 in cash, and signs a note payable to the buyer for $9,000, right? And we all agree the basis on that property is $10,000, agreed? Even though the taxpayer only put up $1,000, okay, it's as if they paid $10,000, agreed? Agreed. What was that, Nick?
You just gave us our answer, agreed.
Okay, $1,000, right. It's personally liable, so it's a recourse. During 76 and 77, takes depreciation deductions of $3,100. We know that's going to reduce the basis, right? Code section 1016. Simultaneously, A is going to reduce the principal on the note to $7,600. Then he's going to sell the asset. The buyer pays $1,600 in cash. Certainly, that's part of the amount realized. Going to assume the liability, whatever the current outstanding liability is. A becomes secondarily liable for the repayment of the liability. A's amount realized is $9,200, right? It's the cash received plus the $7,600 of debt. They look at the basis, it's been adjusted downward, right? Because of the depreciation deductions, and from there, you can compute the amount of gain, right? Everybody, for exam purposes, you can all handle that, right? I encourage you to look at the other 3 examples. I don't need to read those to you, but they're pretty self-explanatory, right?
So it doesn't matter if the liability is recourse or non-recourse.
Doesn't matter if the liability is recourse or non-recourse, right? Right? Now, no, I just wanted, I believe I said to you guys a week or 2 ago, my 1-page outline, yes? The Crane decision? People? Yeah, I did, okay. All I needed was one person to say so, good. Look, numerically it's pretty straightforward, right? The value of the building and the land was about $262,000. The debt totaled $270,000 ultimately. They sell it, she takes the position, she only has to recognize $1,250. Because of the depreciation deductions, the basis was adjusted downward. The IRS says, gee, the amount realized includes the debt plus the cash received. And you just then apply, the IRS just applies this formula and comes up with the fact that she has to recognize $23,000, right? Any problems, any questions on that? So that's the takeaway to the famous Crane case. Very well known. Any questions? You're all good? All right. Fast forward about 40 years. Commissioner B. Tufts. Anyone up beyond the first 2 rows who say, gee, they read this case and found it interesting? Is that you, Claudia?
Commissioner versus Fox.
Yes. Nikisha, did you read it too?
Yeah, I mean,
All right, so Nikisha, you want to double team here?
yeah, we can,
All right, so Connie and Nikisha, what happened?
There was a construction company that took 1.8 million to build buildings. And it was a non-recourse obligation.
And so they make an acquisition for about 1.85 million, right?
And they took a mortgage on the building.
Right, they didn't put up any real money of their own, right?
Yes. And then there was a discussion based on the adjusted basis of the depreciation.
Did they take depreciation, Nikisha?
well, they took, launching and depreciation.
Right. We took about $440,000 depreciation deductions. What does that do to our tax basis, Nikisha?
It reduces it.
Reduces it, right? Code section 1016. Everyone agreeing? You make an acquisition, you buy it, you take thedepreciation deductions. So their adjusted basis in the building goes from 1,851,000. Your adjusted basis in the building goes down to 1,455,740, right? This becomes the adjusted basis. Okay, what happens next?
There was a layoff, like a major company laid workers off.
Right.
And as a result, the income that they expected from the building didn't happen, so I think they went into foreclosure.
Yeah, how much was the building worth? And they, remember, it's not a recourse, so.
1.4.
Okay, everyone agree? The fair market value is 1.4 million. Keisha, Kavya, did they take the loss? Because it looks like they have a $50,000 loss here.
Yeah, they took a loss.
Did they, Kavya? You want to read footnote 1? Loss was the difference between the adjusted basis of 1.455 and the fair market value. On their individual tax returns, the partners did not claim deductions for their respective losses. Now, what do you think, Nikisha or Kadia? Does your antenna go up when you hear about taxpayers not taking losses?
Something shady.
Anything, Kadia?
There is something shady there.
Something smells in Denmark, right? Because when taxpayers don't take losses, I think, and I'll see if you agree, maybe, call me cynical, trying to slip something under the radar, right? If you take a loss, isn't it more likely your tax return will be audited, right?
Yes.
And if you don't take it, maybe it'll disappear. Because what's their fear here, Kadia? What's their fear, Nikisha?
I think regarding the depreciation, because we took that and we also took the losses. And
So what is their potential exposure here?
Oh, so rather than take the 55,000 loss, they've already taken 39, so they figure
they will duplicate.
we won't report this.
Well, when they give this property back to the bank, what's the liability on the property?
Zero.
The liability?
On,
Well, their personal liability is zero, but what is the actual liability on the property itself? It's 1,851,000. John?
I think for my theory, might it be that the value of the property was never 1.8?
I don't, I mean, maybe not because it was non-recourse, but let's assume there's no reason for us for the moment to doubt that it's 1.8. There's nothing, at least I don't see any facts that say that was a sham. I know people bought movies and they overpaid, but it was all non-recourse, so they could juice up the deduction. So I know why you're thinking that, but at least in this case, there's nothing suggest that there's something sinister about the initial framework of that. But I know why you're thinking.
Oh, I see.
You see, Nikisha, you see, Kadia, that the liability here,
I
right?
see. Yeah.
So, Jay, what's your big fear? What's the fear? I'm sorry?
1.8%?
Is the liability.
Yeah.
So what's their fear, the taxpayer's fear?
That itself.
I'm sorry?
The liability?
Remember, it's non-recourse, so they're not losing sleep about that. The boogeyman can't get them for that, but the IRS can, right, Nikisha?
Yeah, I think I got it now. I think the debt was 1.8.
Yeah.
When they got rid of the property, the debt became 1.4.
What do you mean, the debt became 1.4?
Because the property was only worth 1.4, but they owed 1.8. So
This gets to the issue of what is their amount realized. Alicia?
Well, the 400,000 was forgiven, yes?
How much?
400,000? Because
Oh, okay.
originally what
I mean,
the
that's what-
should be.
That's what our Justice O'Connor said, but the reality is, what the case says is, and what the IRS claimed is, the amount realized is not the 1.4.
1.8.
Yeah, the amount realized is $1,851,400. The amount of the liability, or $500. And this would yield a gain of about $395,660. Or 760. I had to just check the numbers. I don't care if I'm off by 100. That's not the important point. So, Nikisha, Kadia, the Tufts decision, and ultimately who prevails here? Taxpayer or the IRS? IRS, right? Is that what ends up happening here, right, Nick? Is that what do the principles of Crane teach us? Is that the amount realized includes not only cash, but every debt, right, is relieved. And in this case, the debt here was $1,851,000, right? So that is our amount realized. Sylvia, you got that? And that is the holding of the case. Whether it be recourse, non-recourse, doesn't matter. So for exam purposes, for client purposes, do not only count the greenbacks. Whatever debt is relieved here will give rise to taxable income, or amount realized, right? Claudia, you were going to say? I heard you
This
whisper.
is section 1001.
1001, but remember guys, if you look at code section 1001B in your code, it's not going to say specifically in the code section, it's not going to say debt. But who am I to stop you? Next to code section 1001B, to remind yourselves, you may want to put in the words Crane/Tufts. Those are two very famous Supreme Court decisions that stand for the simple proposition that debt is considered part of the amount realized, right? And if you fail to forget that, I'm not saying this in a threatening way. I'm saying this, it's not going to bode well for exam purposes. It's not going to bode well for your tax practice, right? You got to know this. This is not stuff that you can, say, I'll figure it out later. You hear? You okay? Yep. All right. All right, so everyone's sure they've got this, because we're going to do some of these problems right now. We're going to see if you mean it. So is everyone ready? We're going to look at the problems on page 158. We have mortgager purchases parcel of land from seller for $100,000. Mortgager borrows $80,000 from the bank and pays that amount and an additional $20,000 of cash the seller giving the bank a non-recourse mortgage on the land. The land is security for the mortgage which bears an adequate interest rate. What is the mortgager's basis in property? So, Jackie, what's your answer, and Karen, see if you agree.
The basis is, what he bought it for, from $100,000.
I'm sorry, say it loudly.
The basis is what he bought it for, from $100,000.
What's your authority, Jackie?
I don't know. I didn't.
You're gonna know that soon, right, Karen?
I agree.
What's your authority, Karen?
10, 12.
Luke, you agree?
10-14.
No one's dead, Luke.
So it's at 10-16.
No adjustments. James? Say again?
I was gonna say 10-16 also.
But there's no gift. You can't say 10-15, Jack?
I like 10-12.
I'll go with 10-12. Just want to make sure that you weren't disagreeing with Karen just because Karen said so. And you agreed that it's all emanating from subsection 10-12, okay? So the basis, even though the equity is smaller than 100,000, the basis is still 100,000. Agreed? 2 years later, when the land is appreciated in value to 300, the mortgager has paid only interest on the $80,000 mortgage. Mortgager takes out a second non-recourse mortgage for $100,000 with adequate rates of interest. The bank, again, using the interest as security. So it's a second loan, okay? The property went up. It took an additional loan, okay? You have additional, Johanny, income or not income? What do you think when you take out the loan? And Tarina, see if you agree.
Not income.
Not income. Tarina?
Not income?
Why not? Even though you have an extra $100,000? Do you agree? Income or not income? Not income, right? Tarina, you don't feel richer, right, when you borrow money, right? You shouldn't, right? No one should here, right? So, no income. Agreed? What is mortgager's basis in the land if the $100,000 mortgage proceeds are used to improve the land? In this case, Jay, Katie.
It's increased by 100,000.
Katie, agree or disagree?
Right.
Tina, is that right?
Yes, so it's 200,000.
What's your authority, Tina? You're whispering. That's your yellow voice? Much better. 10-16, right? Just the basis upward. What is mortgager's basis to land if the $100,000 mortgage proceeds were used to purchase stocks and bonds with $100,000? In this case, Ashley, Larry, what's the basis? Yes.
I would still say 100,000.
Larry, agree or disagree?
I agree.
You agree? And then Joanne, final word?
I agree.
Okay, basis does not change under those circumstances, right? The stocks and bonds would have the basis, not this property, right? Question E. What results in facts of D above if and when the principal amount of two mortgages still 180, the land is still worth 300,000. Mortgager sells the property subject to both mortgages, purchaser for $120,000 in cash. Okay? That's the first part of the problem. Purchaser is going to receive $120,000 in cash. We're getting back to the facts of D above. So, Jesse, Stephanie, Brandon. Brandon, you want to tell us any gain or loss here? And then Jesse, see if you agree. Excuse me?
The basis is $120,000.
I'm asking if there's gain or loss and how much.
I'm not sure.
Stephanie, and then Jay, I'll ask you to see if you agree with Steph.
Loss?
Well, Stephanie, what code section are you applying?
Not sure.
Not sure. Jay, what code section are you applying?
Well, I was gonna say it's a gain of.
Well, before you get there, let's not put the cart before the horse. What code section are you applying? You hear the word sale or exchange to hear what code section? 1001, no question mark. Code section 1001, great. So Jay, what's the amount realized here?
200,000, the gain.
You're getting to the word gain. I want to know what is the amount realized, not, don't tell me the amount realized, not the gain.
300,000.
300,000? Zach, you're great.
I'm a little confused by this whole scenario, yeah.
Okay, what are you confused by?
So is he getting $300,000?
I'm sorry?
Is he getting $300,000?
He's getting 120,000 in cash. DA, what's his amount realized?
120,000.
How do you say it's how much?
122.
I don't think Nikisha's agreeing with you.
I'm going with
So
300,000.
you go with Jay's answer. right?
Yeah.
And I always say, go with Jay's answer. All right? Because why? Jay, what's your authority?
1001.
Well, 1001 says a lot.
1001B.
1001B.
Yeah, plus Nikashi, seal the deal. I say it again. I'm going to keep blowing her in. Nikisha.
It rhymes with Alicia.
Runs with what?
Alicia.
Alicia, Nikisha, okay. I think I'm in good days. I know what my code says. First name is always a problem. All right, Nikisha. What's your authority aside from 1001B? Brandon?
Regulation 1001.
Well, that's good. You're saying the regulation, but always cite to a Supreme Court case. You're going to cite to Crane and Todd. Right? Everybody ready? By the way, I'm going to take the honors, Nikisha. I'm going to circle the E. Try to remind myself that we really want to put an emphasis on this E. All right? So I need all the crutches I can get. All right? You guys can laugh, but we'll see how well you do with Nikisha's name. All right. All right. So the amount realized is 300,000, right?
Yeah.
And Jay, what's the basis here in that property?
100,000.
100, right? So Jay, you got the right answer, but it explains to the client, meaning we could all compute the gain then, right? 200,000. Agreed? But it's very useful, I think, not to jump to the conclusion and say, what's the amount realized? What's the adjusted basis? Right, Louise? Yes?
Yes.
All right, get the gain. Is that gain recognized, Louise?
Yes.
What's your authority?
The greater than.
Louis, what's the authority?
1001?
1001 what?
1001C.
1001C, right? It's going to be all, it says 1001C under the subtitle, all realized gains are recognized, right? Except as otherwise provided. Wes?
Just real quick, going over the 1001B, it says firm like plus the minor C, so would it be 300,000 plus the 120?
No, it's 120 plus the liability, 180.
The crane case.
All right? Zach, you got that?
Yeah, I was just confused by the liability part.
People do get confused. Don't you be one of them. All right? Alicia.
So now who sells bonds?
Hold on. Let's just close this. What is the purchaser's basis in this property? What is the purchaser? Evelina, what's the purchaser's basis? Give me a number, and Diana, see if you agree. 120. Diana? Agree or disagree? Busto? What's the purchaser's basis? How much? 300. Michael, who's right?
120.
120. Alicia?
The purchaser's basis.
That's the question.
300,000 because they spent cash 120 and they have to assume liability 180. So
All right, the basis here is the cost basis. It's 300,000, guys. That's what the purchaser essentially paid. Like akin to Mrs. Crane, it's not the equity in the property. It's the acquisition. And it's akin to the purchaser paying 120 and borrowing 180, right, Jeff?
Right.
So the basis here is 300,000. Zach, you got that? Right? If you bought property, would you tell people, oh, I only spent 120, or would you tell people, Jessica, that you spent 300,000 if you acquired this property? Is that your basis? Hell yeah. Right? Questions? Alicia?
now, if the seller now sells the bonds for
No, let's just say, oh, you mean the original seller, right?
original seller sells the bonds for 100,000.
Right? No gain, no loss.
No gain, no loss.
You might realize it's 100, the basis is 100, no gain, no loss. Okay? Everyone's got that. Everyone has two answers to this problem. In question E, the answer is $200,000 gain, and that's to the seller, and the purchaser has a basis of 300,000. Everyone has that in their notes. Everyone understands where we got those numbers. Question F. What results in the facts of D above if instead mortgager gives the land subject to mortgages? There's two, remember? One for 100,000, one for 80. Still worth 300,000 to her son. Okay, so picture. Mom gives this property to her son. Luca, Yolanda, just tell me any gain or loss here. To mom.
So mom. No gain.
No gain, no loss. Yolanda, agree or disagree, and then David, see if you agree. Yolanda? Not sure. David?
Yeah, I thought so.
No gain, no loss. Edward, agree? Not sure. Matt? No gain, no loss. Anna?
And it's, no, I'm sorry, it's a gift.
Who's it gift?
Can be our son and our kid.
Nikisha. Your hand's half up.
Yeah, I'm gonna go with majority on this one.
You gotta be careful, that's the majority. Come on.
I'm gonna
Louise,
say-
is your hand at half up too?
Is no gain or loss for transfer for spouse?
What, but they're not, this is a kind of sick relationship if she's married to her son. This is not Kentucky.
Yeah, I would say no.
Joanne?
I'm just gonna go with the other answer. A gain of 80?
Wow, look at you.
Wait.
Look at Joanne. Why?
Because there was, her basis is 100,
Everyone agree, mom's base is 100, right?
Yeah?
Yes.
Yeah.
and she still owes 180,000.
She owes 180, and she says, I love you, son. Take over this property, assume the liability, right, son? Ah.
So she leaving instead of me.
What's her amount realized again, John? John?
80?
Well, her amount realized is 180.
Yeah, well, yeah.
Be careful. Her amount realized is the amount of liability she's shedding, right? If someone assumes her liability, that's part of your amount realized, right? What's her basis? 100. Gain? 80.
Can we go through this?
Everybody agree that mom has $180,000 of liability on this property, right?
I don't see that.
Look at the prior problem.
Okay.
I'm sorry, yeah.
The first mortgage is 80,000, and then
Second mortgage of 100,000. The total liability is 180. Her basis is 100. Right? Keisha, what's the problem?
The problem is, the 180 was stated in problem E.
No, it's problem D too. Absolutely.
All right.
All right?
I'll go with it.
So the gain here.
it's kind of confusing. Because I thought in C we said that it would affect it, but in D we said, I thought it didn't. because
Well, it didn't affect the basis, but there's still two liabilities on the property, right, Ashley?
Well, one's associated with the stocks.
But that's immaterial. That's going to the basis. The property itself is still subject to two liabilities. You can't make that disappear. It just wasn't a basis adjustment.
So that is the house collateral for the second loan.
Yeah, it's not a house. I don't think it's a different. It's a parcel of land, but yes, still collateralized by the land.
Okay.
All right.
So I just like, some, son's basis is 280.
Well, I didn't get there yet. We're talking about the gain to the mother. The gain to mom is 80,000. Okay. Now, what's the son's basis in the land? What is Luca?
100K,
100K. Why?
1015.
1015. Let me call your attention to 1015-4. Treasury Regulation 1015-4. We're going to have that 1015-4. Luca, what's it entitled?
Transfers in part of gift and in part of sale.
Okay, everyone see that? Transfers in part sale, part gift. Why don't you see it? It's under 1015-4. Okay, everyone have it? You're looking in the wrong place. Yeah, but it's in the regulations. Put her in the back. Okay, so help her out, please. And now that you don't have your code, you got it? Right. David, you're looking for it? All right, 1015-4, Treasury Regulation. Luke, upper tier, you got that? All right. Luke, what's the basis then to the son when you read this regulation? Now, is this a part sale, part gift? Isn't mom saying to the son, look, son, I love you. I have this beautiful piece of land. It's worth $300,000. It is subject to liabilities of $180,000. I want you to assume this. So notice the part sale part, right? Mom's selling it. She's saying, son, you're essentially, I want you to take it subject to liabilities. Essentially, son, you're going to pay $180,000 for this. The other $120,000 I'm gifting to you, right? Do you see the bifurcation? Now, obviously, she's not saying that. But I mean, we're trying to classify her actions. Mom loves son. You know, obviously that's my spin on this. But why would she be that's motivating her to give this property. But her love only goes so far because she's not paying off the liability and then giving it to the son. She's saying take it subject to the liabilities, right? So that's considered a part sale, part gift. Luke, what basis does son have in the property?
180,000.
Okay? Because when you read 1014-4, essentially says, use whichever of the following is greater. The amount paid by the transferee to the property, that's 180, or the transferor's adjusted basis in the property at the time of transfer, that's 100. Last I checked, what's greater? 180. Luca, you see that? Basically, 180. You can never get that from reading the regulations under 1015, right? Excuse me. You can never get that from just looking at code section 1015, right? Katie, you got that? So your answer for your notes is, mom has $80,000 gain, son has a basis of 180. Question G. What results in the facts of F above? The mortgager gives the land to her spouse rather than to her son. Okay? In this particular case, what if that exchange happens? And Jackie, any gain or loss here?
They give mortgage just one half.
I'm sorry?
I'm not sure.
You sure, Sharon?
Little gain loss.
What's your authority?
10%.
Authority you? 10 what? 15? Who's that? Johnny? 1041, right? No gain, no loss. Serena, what's the son's basis? Excuse me, the spouse's basis in this property? Serena, Larry, see if you agree.
The spouse's basis.
Yes, the purchasing spouse's basis. Larry, you were going to say? 100? Ashley, would you agree?
You know what if the spouse wanted to carry over so that it doesn't affect when they sell it? They capture that same basis, but now that there's 180.
Serena, you want to come back at it?
I'm thinking about, because are we still talking about the stock as well, or?
No, she's just giving the property, the land, nothing to do with the stock. And Ashley, if you want to come back, you want to, what do you say the basis is to the purchasing spouse? Serena? Serena? Not a trick question, guys. It's 100,000. I mean, come on. 1041, just like Johnny said, there's no gain, no loss, right? And of course, Congress is going to seek to preserve the basis, right? 1041B says treat as a gift and it's going to be carryover basis. There's no part sale, part gift, right? Look good in this context. So we just have our normal rules applied, right? Question H. What results to mortgager under the facts of D above if the value of the land declines from 300,000 to 180, and mortgager transfers the land by means of quitclaim deeds to bank? Okay, so mortgager just simply walks away from the property.
I think we missed the part of the question, G. What is the spouse's basis in the land after spouse pays off the 100?
Oh, I apologize. What is the spouse's basis in the land after he or she pays off the 180,000, Wes?
We're still behind.
Yeah. There's every expectation, and that's why the basis doesn't change. It was already built in when the property was acquired. In other words, just take a simpler fact pattern. When you buy a property with $20,000 in cash and $80,000 worth of loan, your basis is 100, right? When you pay off the liability, there's no code section 1016 basis adjustment, right? pertaining to the payment of principal, it's already assumed you're gonna pay off the principal, right? With after-tax dollars. That's why you've got a full $100,000 basis to begin with. So question H, in this case, David, Matt, any gain or loss here? How did you get that? What's the amount realized?
Sorry, 180.
What's the basis?
100.
Gain or loss?
80.
David, agree?
Yeah.
Anna?
I do agree.
Okay, be right. The answer here is the amount realized is 180. The basis is 100. Gain here of 80, right? Question 9. What happens if the value drops? 170. Diana. Evelina. Any gain or loss here?
Is it the same, the 80?
Is it at 80, Diana? Jessica?
Not realized it's still with that.
Say again?
Not realized it's still with that.
The amount realized is still 180, right? Right? What decision is this? What, Nick, what court decision would you cite to here?
I would cite to the Topps case.
Yeah, this is Topps in one sentence, right? Everyone agree? Rafael, you got that? You got it. Zach, how you doing up there?
All right.
You got this? Nick?
I just wanted to ask you about problem E1E, where it says that the purchaser paid for $120,000. So why wouldn't that be the cost basis?
Because remember, when you take property,
You have
it's
to pay off the mortgage too?
Yeah, I mean, you're obligating yourself to pay that liability.
Okay.
So the answers to question H and I are both 80,000. Ashley?
I have a question about, it just seems like there's some disparity to me that it doesn't affect the basis, but it affects the amount realized.
When you say the liability does affect the basis, meaning you don't look when you acquire property at the amount of the liability, right? In other words, you look at the fair market value of the property or cost basis, but embedded in that is the liability itself, right, Ashley?
So in C, you increase the basis by 100,000.
Well, that's because the cash or the borrowing was used to improve the property.
So it just goes back to the fact that it's collateral and it's getting basically forgotten. So that's why it's realized. I think at the top.
I mean, when someone has property subject to a liability, and someone purchases it, you're being relieved of that liability, whether it be recourse or non-recourse, right? Think about it. Look again at the Tufts case, look again at the Crane case. Question 2. Investor purchased 3 acres of land, each worth $100,000 for $300,000. Investor sold one of the acres in year 1 for $140,000, and the second in year 2 for $160,000. The total amount realized by the investor was $300,000, okay, which is not in excess of the purchase price. Can an investor play that game? Can an investor try to use the basis that he or she has strategically to minimize the gain? And the answer is no. If you were to look at that regulation, 61-6A, the basis has to be allocable $100,000 to each of these properties. $100,000 allocable to each of these properties. And that being the case, if they sold one for $140,000 in year 1, they recognize $40,000. They sold it in year 2 for $160,000, they have to recognize $60,000. let's do this, guys. I understand that the Rutgers Business School is sponsoring a break right now, where there's free food and a drink.